seeing its highest close in 9 months after CEO Mark Zuckerberg announced yet another round of layoffs. Zuckerberg telling employees the company is looking to reduce costs and flatten its organizational structure. As a result, the company expects to reduce, quote, our team size by around 10,000 people and to close around 5,000 additional open roles we haven't yet hired. Joining us now is Brent Thill, a senior analyst at Jefferies. Brent, always good to see you, my friend. So what's the impact on growth for Meta?
Well, the expense structure was way ahead of the revenue growth. So I think what we're doing now is bringing the expense structure down to where growth is at. And so, they've cut effectively almost $10 billion of expense out, which just tells you, how overweight they were on potentially unnecessary roles. So we now have over 20,000 job cuts. This follows a number of other tech companies. We've said this repeatedly, tech is overhired. There's a lot more cuts to come. This is not the last cut. Salesforce is cutting, Microsoft's cutting, everyone else in the industry is cutting. So it's matching what the rest of the industry is doing. It's matching to get back to where the revenue growth is. And effectively, it may be a sign too that the overall advertising market continues to be weak here in the front half of the year, which we've heard as companies are pulling back discretionary ad spend in a tougher economic tape. So at the bottom line, you're talking about a company that's still going to generate, over $12 of earnings power next year. You don't have to put a big multiple on it to get more upside in Meta stock, even though the stock is up 61% year to date.
Yeah, Brent, what do you make of the stock moves year to date up over 60%? Is a lot of that just driven on hope? Is it all driven on the efficiency line that we heard time and time again from Zuckerberg on that last earnings call? Or does a move like this make sense to you?
The move makes sense. I mean, the multiple got overwhacked. Multiple got overwhacked for a number of tech companies. So I think ultimately, when they gave the initial guidance and the stock literally torpedoed down on that guide last fall, they quickly did a reversal, of course. And I think it tells you that Zuck is in tune with what Wall Street wants. He's listening. He didn't do what he just wanted to do. He did what the right thing to do was. So I think ultimately that these cuts are important. They obviously are tough to get through, but I've said this repeatedly, technology is not a good hockey player. They are not skating to where the puck is. They are skating behind the puck. And if anyone's played hockey, it's a hard thing to do to catch up. And so they're really getting ahead of this now. I think it's a good thing. I think ultimately, again, in advertising, you don't have what's called deferred revenue like you have in software. You have no visibility. And so perhaps what can happen is maybe they went through this first quarter and they saw, a lot of advertisers turning down. So that's another concern that we have, that perhaps just the overall demand environment for advertising is effectively falling, throughout Q1. So that could be another explanation. I think the bigger one is just revenue growth and expense growth were completely misaligned. Yeah. This now puts them on the right path, and they've done a fantastic job. They've done a better job than most when everyone thought Zuck was just going to go spend on the metaverse, and clearly, they're pulling off that message a little bit here.
Well, that's what I want to ask you about. I can't help but think, what were these 10,000 people doing if it has no impact on their growth trajectory? But as to your point about the metaverse, what does this tell you about a possible shift away from the metaverse and towards what?
AI. It's all towards AI. Our sources have said that on the inside that they're basically making a message towards artificial intelligence and a little less towards the metaverse. Now, there was a commercial last night that showed a woolly mammoth with your headset on TV during the Warriors game. And so you think about, they're still pushing the metaverse. They're not going to go away. They're not going to pull back from the opportunity here. I think they just don't have to push as hard, and I think they have to push a little harder around AI. And that is what they said, back in the fall. They were spending so much in CapEx. They were building up these new data centers with these new AI clusters. And I think when you think about kind of what's happening, that tone's resonating with Wall Street right now, which is their core advertising opportunity is the biggest opportunity. You make the AI better to see what you care about. And effectively, then you can convert those customers into subscribers of different products, sell different pieces of commerce, different products via commerce. There's a whole opportunity that comes available. Again, I'm not sure that my kids' grandparents are going to be putting the metaverse lens on, or we're going to be putting it on in the short term. So I think it is exciting. It's a long-term opportunity, but I think it's the right one that they're pulling back the throttle on Meta. They're pushing forward the throttle in AI, and again pulling back overall expenses. This is resonating well. The one piece of this puzzle, I'll be very clear, we don't know, is like what's going to happen on the revenue side, and that's to me still a little bit of the scare factor that you have to be worried about in the short term on the stock.
And Brent, it's been a pretty busy couple of days within the tech world with the collapse of SVB. A lot of people asking what exactly this means for the tech industry at large. How are you viewing this as an analyst? And I know you cover most of the larger companies within this space, but how big of a threat maybe do you see it being in terms of M&A or anything like that down the road?
I mean, there's wonderful people there, and I feel terrible for what happened. But I'd say that ultimately this has an impact on smaller private emerging companies. Most of our companies didn't have big exposure to SVB. Certainly, I think when you think about investments are still going to happen in the venture world, lending is going to get done, but perhaps there's going to be a greater scrutiny on the risk curve here. So, instead of taking 10 shots on goal, maybe we're taking 5 shots. And so I think ultimately for the private world, it's going to have a bigger impact. I still think valuations are coming down in the private world. They haven't matched the public world. We hear this from IEC. We're more interested in buying public than private. We hear it from even venture capitalists we work with. The private markets is rational. The public world's rational. The private world is not rational yet. So I think this is only going to accelerate the pace of overall multiple compression in privates where it needs to be. That's a good thing. It's not a good thing to have a bank fail, but it's a good thing to have some expectation reset. And I think this is only going to accelerate that reset. I expect M&A to pick up. I expect venture capitalists to be a little more conservative and probably have a slightly higher level of due diligence before they make the move. So I think everyone's just a little more hypersensitive around the risk factors, which is a good thing. Ultimately, again, not been a great thing short term for the industry.
All right, Brent Thill, always great to get your perspective here. Yahoo Finance, look forward to talking with you very soon.